make this not only an opportunity to ask questions to the speakers where maybe time hasn't been there. Nice to have you. Please have a seat. But also want to dive a little bit into the next 5 years horizon, and yes, maybe also debate some of the impacts that we've heard of all day. I think risk management seems to be one of the more interesting functions to work in these days. And maybe just as a bit of a follow-up to Björn, what you just have been presenting. I mean, there's just a multitude of different risks and different dimensions. I think you gave a really good overview of that. No need to repeat that. But how much is risk management now really embedded in developing new strategic business models? How does it change? What are the changes that you've made to your function, for example? Do you have new skills, new talent employed? How do you react internally, and how you organize risk management?
Well, that's a big question. So how is it embedded? I would say it depends, right? So, you have risk sitting on the management board, I think, in every bank. So it is there. It is and that's not new. That's the case for many years, and it is a key function for the management board, right? So whatever the business is dreaming up to do, it has to be challenged, and it is challenged by the risk function. Now, have we changed the organization? From an organizational point of view, I think most risk functions are organized according to categories: credit risk, the market risk function, the operational risk, and then you got all these others that are somewhere placed. I think the most interesting one right now that's going on is the topic around ESG, where, because it is so new and it is quite challenging, I can see quite a lot of functions, including risk, and coming together and trying to figure out, what do we do, how do we tackle it, what is our strategy around it. So that's I think one that is really different, the way we operate or we tackle, compared to, let's say, the more traditional risks that are BAU, and you got your committees and you handle it there.
And Andre, I think that was also a point that was mentioned earlier by your colleague Marta about ESG measurements, and how difficult it would be to make banks responsible for that, for the results. But how are you in your, as a wealth manager and as an investing firm? How do you work with the data that you receive? Do you just trust it, the data that you buy from providers? Do you create your own data? How do you really surface all the hidden risks that might be in the companies and the supply chains of companies? There's much more regulation coming up now about having oversight of that. Can you maybe just share a little bit how you're getting on top of that, and how you're positioning yourself?
Yes, sure. So, well, I would say that's one of the big challenges is data. What we see is that, of course, a lot of providers showing up in the market, trying to somehow grab as much as data and as much as consistent across, several providers as possible, is a huge challenge. Of course, we are still in the beginning of grabbing those data. We use some external sources, but still a lot of, I would say, express judgment as per interpretation of those data, and having our own criteria in terms of level of alignment with the ESG criteria. We are an investment bank. We are not a retail bank, so we don't have that huge challenge of kind of educating SMEs and corporates towards becoming more aligned with ESG, and with that have a lower, a better pricing by the end of the day. We are more on the investment banking side, but and under that hat, we have a strong wealth management and particularly investment advisory area. For that, of course, we need to ask to our clients their preference in terms of ESG. And if they have preference, we need to find the right blocks and the right assets to fill in those blocks, either taxonomy or the pins or the regulation. So, and that's challenging. So we use a lot of I would say expert judgment to do our best in terms of serving our clients' needs.
And client needs, I think, is also a good word. If you think about 5 years from now, maybe even 10 years from now, our client needs are likely changing. And we know how banking can just take a long time to actually adopt. But especially in wealth management, we'll have a massive amount of wealth that will change generations in the coming 5 to 10 years. We have new wealth coming up, entrepreneurial wealth, all the unicorns, the new companies that are being founded these days. How do you factor that in? I think in terms of the future of your bank, are there specific areas that you go after that you find strategically important, and where not sort of creating new offerings would be a risk of not doing?
No, that's for sure. Well, that's also a very good point, because yes, she is going to be there. That's for sure. That's something that we need to follow, and it's not only to serve the clients, but also to comply with the set of strategic governance practices that banks need to apply. Not only because I guess there are much more awareness on the bankers towards these kind of matters, but also because policymakers and the regulators are also producing new laws and new regulations that oblige banks to have this kind of conduct. But that's something that's going to be there, and the banks will need to live with, and I think is also a sign of progress of civilization, I would say. So I think is the path. A different thing that you touch upon, I think, is more related to the business model of the banks and how they will manage a more and more competitive market. I think one of the key matters here is really to be able to follow innovative technologies and to adopt innovative technologies, because particularly these new generation and future generations, speedness is of the essence. So I think banks need to adopt that, such as they create new improved financial services. And of course here, talking about technology, of course, Web3 is at spotlight. Of course, here's still some room to go. I think the technology is already kind of robust in the sense that it is proved to allow to do peer-to-peer transactions while being traceable and traceable and with that integrity. But of course, we then need to have use cases to work on under Web3 and blockchain. We do have already some cases, of course, stablecoins, Ethereum's, Bitcoins with some track record. I think in a year we'll talk about stablecoins as far as I understand. But nevertheless, we need to have use cases, and then banks, of course, need to leverage on that. I think, well, actually, a lot of banks worldwide, big boys in US and Europe, are already looking at these kind of things, particularly for payments, remittance, secondary market trading, primarily market issuances, even for regulatory purposes or reporting. So all that is already under the bank's radar, and that will change in the future. And I think either the banks follow that rule, or they will be left behind, because high techs, fintechs, VASPs are there with a lot of technology and fitting well what are the needs from the new generations.
Just want to add on that. I mean, all the change, well, a lot of the changes we have seen over the last couple of years in terms of mobile banking and all of these things happened on the individual customer side, or retail, wealth, whatever it is. Now, your customers, the millennials, Gen Z, etc., they are now the CEOs, CFOs, head of treasury, who are sitting in the companies, and they're sitting there and saying, well, what I have here for my personal account, I want that for my commercial account as well, right? And I think so far, there are a few banks tackling the SME side, but I think on the commercial side, there's still a lot to do, and there's a huge opportunity and a demand, right, that we have to fulfill in future.
Anna, when you hear that, so stable coins, CBDC, emerging tech, there was a lot of talk about AI this morning. So from a central bank perspective, what are the risks, especially on the emerging tech side, that you're looking at? Is there, how do you organize? Do you have specific task force? Are you upskilling your people? How do you go about this?
We are integrated at European level, in particular, so both at the macro level and also at the macro level. I work in the macro level, so systemic risk, but we have people in payments that deal with all this at macro level. We prepare ourselves and participate in several committees in Euro area and the European Union. And locally, we also try to even reinforce some of the exercises that are being conducted at Euro area level. For instance, concerning cyber risk, the SSM has recently launched an initiative for cyber risk resilience tests, so to understand if banks are able to recover from an attack, cyber attack. And Banco de Portugal decided to enlarge the sample of banks to banks that are not that important at Euro level, but very important for Portugal. So we enlarged the sample, so apply this to more banks. And we also included, I think this is quite new, I believe just UK and Denmark started doing this. We are trying to incorporate also the systemic risk, systemic cyber risk in these exercises. This is the first attempt, very tempting, but it's very important because so far, fortunately, we didn't have a systemic cyber attack in the financial system of any country, I believe. But you cannot exclude this because this is a tail risk, but you need to be prepared. It's kind of risk that was mentioned that, well, small probability, but huge impact. And with geopolitical tensions increasing, this is very much correlated. So we are working heavily on this with the banks.
And it's a pity we don't have Joe here, who would probably have been and will be sharing his views on cyber risks, on impact of quantum computing, breaking cryptography. I think there's a lot coming towards us that we don't know yet. The pace is really fast. There's a lot of more data as well. I mean, there's satellite data, there's geo data, access that we have that we never had before. But Björn, you showed all these great slides about strategic risk analysis, etc. And it looks like you're monitoring, you're having analysis, you go into the boardroom, you present it, and then you say, this is what we're doing now. Do we really have the time for that? Or do banks have to do real-time risk assessments with the technology at their service, so that reaction or even hedging risks through parallel investments into other business models or into plans that you basically can turn on immediately? Is that just future thinking, or is that already reality?
I think from a strategic risk perspective, that's still future thinking, right? Because, and I'm not even sure it will end up like that you have real-time adjustment, real-time monitoring, and like what you would have in market risk, where you have market prices, you measure the volatility, whatever. I mean, everything can be automated and in real time because the data is there and the deals are happening on that basis. On the strategic side, I mean, you're not making decisions every 5 seconds or every 5 minutes, right? I mean, these are and these things require discussion, and they require consent, and they require also some fairly deep understanding of the issue, right? So question was, do we have the time? I think we have to take the time, right? I mean, you're running a business, right? You're not just, just shooting from your hip and say, oh, we do this, right? So you have to take the time and say, so what is important? So where do I see my opportunities? Where, to your earlier point, right? So how will the customer behavior change? How will the wealth change, etc.? So where should I be? And then, of course, okay, so what could jeopardize this type of business? I think it is still some sort of a manual thing. Now, having data and having tools and algorithms around it to better analyze all that data will definitely help to improve the decision making, right? Give you more insight on what could happen. But it will just be a tool. So it will not take the decision making away. That's my view.
So the AI augmented risk manager.
Yeah, but only to provide information. You still have to decide, what does it mean for my organization, and how does it fit to my strategy? Otherwise, you can put an AI tool and say, well, run the bank and remove the CEO. I don't think that's going to happen.
I have 2-3 more questions, and then I also want to open up for you to ask questions, because we've been very short today with question times in the presentations. But we've heard quite a bit about software as a service, about big tech, about Copilot, about Google, about all the tools in the ESG space. We've just had London Stock Exchange taking over Refinitiv. So there are these large providers of both data, ratings, but also technology, large language models that will serve us. So, Andrew, when you think about making decisions, and you're probably also buying tech, you're not developing everything yourself. Will we have, in 5 years from now, will there be just a few providers and banks? How will banks differentiate? Will we have a risk of dependency? Is that something that you're thinking about?
We hope not, quite frankly, because we see technology developing very fast. Of course, there are still these big techs that are going to be there and trying to grab as much as market as possible. But I think still is going to be room for other players, more niche players that can be specialized in particular parts. So I think that's going to happen. We see, for instance, we at Bison Bank, we have a fully owned subsidiary which is called Bison Digital Assets, which is a VASP in Portugal. Actually, is the only one owned by a bank in Portugal, and that basically is do custody and exchange of digital assets. And under that activity, we see a lot of tech companies coming up, a lot of startups as well, so a lot of movement around these areas, and people really committed to develop and to get a more competitive ecosystem. I think by the end of the day, either we have a competitive environment and a concurrential environment, or things will develop much worse. So I think still is something looking forward, that we hope to be able to diversify and to be able to have a lot of players playing a role.
So basically also more fragmentation, but also more offerings, new players that will come in. I think for you as a supervisor, authorities, yes.
The fact that still there are just a few important suppliers is a source of concern, and this is something that is being tested in the exercises that are being conducted at the SSM level, for instance. So this is an issue that at the moment is already a source of concern, because it's a very concentrated market. if indeed evolves as you said, that would be good for for risk at world level. But at this point in time, there's a lot of concentration of supplies for all banks.
If you think about 5 years from now, what's kind of keeping you up at night? What's the biggest risk that we need to prepare for?
For me?
Maybe starting with you.
Well, for me, it's geoeconomic fragmentation come from geopolitical tensions. I think this is really very worrisome, in particular because several risks that are very important now, climate change, even cyber risk, is very correlated. And climate change, you need a lot of multilateral cooperation, and it seems it's going to lack. And so clearly, and this may have a very strong impact on economic growth at the global level, so a negative supply shock. Already the IMF incorporates in the baseline some negative effects coming from economic fragmentation already in the baseline. They are forecasting 5 years from now a growth for the global economy, which is the lowest in decades. This is the baseline. And 5 years from now, even worse. So I'm not alone here. This is something that is a very big source of concern, and of course, very much correlated with cyber risk, because data and cyber attacks are a weapon more and more. So for me, going forward, indeed, the two that I find. And I'm talking about a high risk of a full-blown war between China and the US. I'm just talking about creeping geoeconomic fragmentation.
Andre?
Well, I also agree. I would just add the business model risk or strategic risk. I think is quite important because market overall is getting very competitive. A lot of newcomers from different, looking at the financial system, of course, other players, different nature, competing for the same market. But with a different profile. So for banks, it's going to be quite important to find a way of getting its own niche, is competitive advantage. This is more and more important as we move ahead, because they're gonna not only compete among themselves as they have been doing through the last decades, but they're also competing with the very new and strong comers, very high tech profile that fits a lot this new generation. So I think that's going to be quite important to have a profitable and consolidated business and distinctive business model as we move ahead.
Yeah, what keeps me awake at night? I mean, I had 6 slides, I think, that summarized the key issues that I'm thinking about, so I don't have to repeat that. But I totally agree with you on the business model, or let's say the more strategic perspective, or the challenges that banks have. I mean, we've spent now 10, 15 odd years to do digital transformation, to be like the fintechs, and it worked out, right? We all have beautiful mobile apps. We have now digital onboarding, digital sales for pretty much every product. So the question then is, from a customer point of view, is why would he prefer to bank with you and not with somebody else? Because the service is pretty much the same. We focused a lot on providing this seamless service, to optimize our processes, to digitize our processes, and in that process we kind of moved away from the customer, right? Everybody agreed that, well, we kind of need to give up the branches, right? They're not the future model, but in the branches you have a customer interaction, a personal interaction. With these mobile applications, you just completely gave it up, and now it's all about which one is maybe a little bit flashier, but it's not something that is sticky, I would say, right? It's so easy to just open another account, transfer money to the next account, you get a little bit more interest rate, you keep it there, then there's another card offer from somebody else, you go there. So as a consumer, you move around. So how, as a bank, now do you get this connection with the customer back without opening branches, obviously? Well, that's not the solution. How do you be more relevant to the customer? I think that's the question really we need to ask. And some of the presentations today talked about now let's use AI. AI can improve the interaction, improve the chatbot. Most of these points were still around, again, improving the process itself, but it doesn't really add, in my view, a lot of the let's say the connection between customer and the bank. So that's really
and it is very interesting that even in the UK, where they mandated that account changing should become simpler, the actual change rates, and I'm sure that the presenter from Starling, I don't know if he's still there, could speak to that. The actual change rate have not been that high. I mean, nobody, I think it was said before, wakes up in the morning to bank or to change bank unless they really have to. So typically, customers are quite patient until they make the change, because it is quite hard. But younger generations, I've seen data, are much more willing for simple services to move over. Loyalty has eroded and is much more with digital players than it is with banks. That's for sure. I think there's lots of changes. There's probably one last comment which I found really interesting. Chief economist from UBS. I've been with UBS for the last 10 years. Paul Donovan wrote an interesting small blog about how he's been reducing the GDP on a day just by doing all the work himself, being at a home office, not using office rental room, checking in himself for the flight instead of using a person. There's a lot of unaccounted value with the digitalization that we don't even see in GDP, and then how we measure the transformation, which is almost like worth a separate discussion. But I'm sure there's some other questions out here to the panelists. Anything burning before going to dinner?
It's fine. So just a quick question. I'm sure you're familiar with disruption and S-curves, right? So for example, disruption would be Uber and traditional taxis, but a jump in the S-curve is droid delivery, right? So actually having drones deliver stuff, which is disrupting that industry. What do you think the jump in the S-curve is going to be for financial services? Any ideas?
I don't have an answer. No.
Yeah. Sorry, do you mind to repeat? I lost part of that. Sorry.
Sure. Can you hear me? Yeah.
Yeah.
So as part of disruption, you have S-curves, right? So basically the stuff you can see coming at you, but you don't know how to deal with, and then the unknown. Yeah. So for example, you've got traditional taxis and Uber came along. So that was a disruption on the same S-curve. But now you have people doing delivery with drones, like Amazon. So that's a completely new S-curve, complete disruption. So do you see anything coming at financial services, which is going to be complete disruption of our industry?
Well, yes. Quite frankly, no.
And I think that this is a really tricky question. I think that there's probably a few that attempted it, right? I mean, with DeFi, we've kind of seen the attempt to move over to a completely new infrastructure, to decentralize, not needing banks. I think we see with open banking and embedded finance, we also see some direction to basically transpose banking type services into other platforms or other services. But having worked in the banking industry now for 20 years, it's a very regulated, very complex and difficult industry. And all of these rules are there for a reason as well, to keep us stable and safe and secure. So I think it's very difficult to say that the banks and financing won't be needed anymore. That's my personal opinion. But I don't know if there's any other views.
Yeah, also yeah, I think that's also a challenge in the long run. I think that kind of movements in the financial sector will take a lot of time. Even DeFi is something that it's going to take, I guess, ages till they are really adopted. And at the same time, I think financial institutions need to adopt different practices and need to adapt to the market, because if they don't do it in 10, 15, 20 years, well, there's the risk that they become, at least, to say the least, much less relevant than they are today. So yes, but I think that we need to have a look on that. But is gonna, I think, is really on the long run, I would say.
Thank you.
It's also very hard to answer, right? I mean, if you look at all the disruptions that we've seen with Amazon, with Uber, and similar things, I mean, one characteristic of these disruption was that nobody saw it coming, right? It just happened. They happened to find the right business model, and then it picked up. So after the fact, I can say, well, that was obvious. Why did nobody think about it? But that's why it's a disruption. So it's really hard to sit here right now and say, well, I see this coming, because if I do, then of course I pivot and I adjust, and I'll try to do myself as a bank. And if you think a couple of years back when the fintechs popped up, and all the banks were shaking a bit and said, oh, they're gonna take over our business entirely. And well, they didn't, right? So they very quickly realized, yes, there were certain pockets that they're easy to tap in on the payment side, but bank is a lot more than just transferring money from A to B, right? And so providing or disrupting this entire model is not that easy. And then of course the regulation side comes into the picture. So we're still here. I think we're still going to be here in 10 years' time, probably longer. In what shape or form is the question, right? So will we be the front end, or will we, as an organization, move more to the back end, and others will handle our customers? I'm not quite sure. So I think different kind of models will end, but I wouldn't consider that as an entire disruption of the banking system.
I would say even the banking industry should think about, why did the $2 trillion move to the crypto? Because the crypto is a $2 trillion market today. It means it moved from the traditional banking. So that is something to be thought through.
Agreed. But how long do we have crypto now?
I know.
Right. So, I mean, I wouldn't call that a disruption anymore, right? So, yes, so it will play a role. And I think banks, again, need to adjust and need to think about what role do they want to play in that space.
And I would say for crypto, I don't see a poorly transfer those 3 billion or 3 trillion, sorry, from the traditional banking into the crypto. Also, a large part of that, has just come from the growing of the wealth from the start. We see if we look at the price of a Bitcoin, terms of yes.
But yeah, but I think it's fair to say that digital assets and tokenization of alternative assets is kind of trying to bring a whole new area, and that can be more liquid or more efficiently traded. We're definitely going to see changes there. I think we'll still have to see how the whole stablecoin CBDC transformation is going to pan out. And those are long-term developments since we started, even with our own work in 2015 in the labs with the utility settlement coin, which is now finality. We're now 9 years later, and it's still in first prototype and pilot phase. So things take a long time, and I think that's where the typical saying about you overestimate in 5 years, you underestimate in 10 years. Is probably right. There's definitely more to come. I'm looking forward to have this very personalized, voice-controlled client advisor that is just with me. I hope I don't fall in love like in the movie Her. I hope you've seen it, 2013, quite visionary for that time. And not to bother about my finances anymore. That would be fun. And to know that all the risk management is so real time, so automated that I definitely won't lose money.